Hello, everyone. Hope everyone is doing all right. Today, I'm just going to talk about volatile and non-volatile markets, impulsive and corrective moves, and support and resistance. So, volatile market is a measure of the dispersion of returns for a given security or markets index. Stocks or other securities with higher volatility are generally regarded as riskier than those that do not experience the same price oscillations. Stocks that experience less price oscillations are considering volatile. So, in other words, basically, markets or stocks that move too quickly and irrationally are considered volatiles, where others that move more sideways are considered non-volatiles. Of course, there's all the pros and cons about those type of markets. So volatile markets are a bit more harder to predict. However, the return on investments are a bit higher, where markets that are non-volatile are more predictable, but the amount of return is a bit lower because they move more sideways rather than moving up and down. So impulsive and corrective moves. So impulsive moves are when the price moves rapidly to either up or down, where corrective moves is the market when the market moves more sideways. Not all markets, for example, talking about volatile and non-volatile and impulsive and corrective. So not all markets nor not all stocks or assets are considered completely volatile or completely non-volatile. They're all in the spectrum. Yeah, of course, there's stocks or assets that move very rationally, therefore considered very volatile, and markets that move less volatile, which are considered non-volatile. Markets move more sideways. But in between those you know that spectrum, we usually have mostly corrective and then impulsive moves. But just for this example, to explain what is impulsive and corrective moves, impulsive move is when the price moves too quickly to one side or the other, and corrective moves, the price moves more sideways. As we can see, it's correcting within this uh, price levels, and therefore is considered to be in the corrective move or consolidation move. So now talking, oops. So now talking about support and resistance, if I can. And now talking about support and resistance levels or areas. So support and resistance levels are key areas on the price chart where the market tends to react. Support is a level where price often stops falling and may bounce due to buying interest. So basically, see it as a floor where if the ball reaches the floor, it will bounce to the upside. Where resistance is a level where when price often stops rising and may reverse due to selling pressure. So we can see it as a roof without gravity. If you throw a ball to the roof, it will bounce and come back down. So these levels help traders identify potential entry, exit, and reversal points in the markets. So basically, you can use this as a point of reference to set up your trades. What we use support and resistance is basically as a confluences where we can use like price patterns or candlestick patterns together with support and resistance to which builds up confluences and therefore the probability of a certain setup to work. If we go on the example, basically support and resistance works as a floor, is a support and reacted, resistance and reacted. Another thing I would like to mention is that support and resistance, once support and resistance are broken, they tend to reverse roles. So what was support becomes resistance, and what was resistance becomes support. So in this example, we have resistance here. However, price has broken down, created resistance there, came back down, and now is considered as a support because the price once reached, it reacted to the upside. Resistance, support, resistance, broken down, reacted again as support, came back up, reacted again as resistance, broken down, support again over here, came back up, what was support over here, now is resistance again, broken down, came back up, now what was support around here, now became resistance, broken up, excuse me, and broken this resistance as well, came back came back to this level, which was support around here, became resistance, came back down, which was resistance here, now becomes support, and therefore reacts like this. So another thing I would like to add is that we have dynamic and static support and resistance, where static is the horizontal lines or horizontal levels to which are support and resistance, and then we have dynamic support and resistance, which it could be used with trend lines or indicators like the moving averages. We could use it as well as with the Bollinger Bands. Um, and that with that said, we can see like here we have the 21 EMA, to which the price is respecting as a support, because the price is reaching it and reacting to the upside, reaching, reacting, reaching, reacting, and just reacting as a support. Another thing I would like to add is that not all levels or the markets will not all respect those levels of support and resistance. Sometimes they will break, sometimes they go a little bit lower and then continue its uptrend move. And therefore, what we need to do when we are trading is that we need to build as many confluences as we can at those points of interest. Like, for example, if it reach um, a static resistance level, and then we have as well moving average there, and then with a pattern and a candlestick pattern, that's four confluences together. And therefore, once the price reaches those levels and we have that pattern and it breaks, therefore we can set up a trade to which gives us higher probability of that trade to work. Of course, we need to follow our rules of our strategy, to which that will help us keep the consistency. And then by journaling and reviewing, we can keep growing as a trader and our strategy as well. So this is basically what support and resistance is. We can go through either trend lines, to which this trend, this point to this point has created a trend line to the downside. And once the price reached that trend line, it reacted, forming a kind of descending wedge, broken down, came back up to this level, which we can say that that's a resistance now, reacted, and came back down again. And if we adjust that level again, give it a take around here, after the price breaks that trend line after this resistance, what we see, support, support, reaction. Came back down, reacted as a support, went back up. Then what we see here is descending wedge, broken out over here, reacted to the upside. So this is basically what it is, support and resistance levels. So we got dynamic and static, where static are levels on the horizontal, and dynamic are any kind of levels which are either, well, basically any kind of levels that are not horizontal. We have volatile and non-volatile markets, which volatility is when the market is moving inconsistently in where the price is moving very quickly without really anything to respect. So basically, the price is not respecting the levels or is just moving irrationally out of the blue, which is that's where the volatility comes from. And non-volatile is when the basically the price is very well respecting the levels and mostly consolidating. And then we have impulsive and corrective moves, to which we can see in this price very easily. Impulsive, impulsive. Now we are in a consolidation, which is called correction. Impulsive, impulsive, came back up impulsively, came back down impulsively, a bit of a correction. Impulsive down, bit of a correction. Impulsive down, impulsive up, correction, impulsive up. With that said, I would like to stop over here because I think I've covered everything I can. My goal is to help others obtain a bit of value, understand a little bit more about support and resistance, volatile, non-volatile, impulsive, and corrective moves, so that they can start seeing the markets a little bit better. Of course, most of advanced traders mostly should know or would know what's resistance, support, and resistance. However, the traders that are mostly starting probably have a bit more difficulty understanding this price, and hopefully, given some value to all of you. And at the same time, thanks for watching another one of my videos, and see you next time.